Friday, March 22nd. Happy spring. I'm going to try to make sense of this, but the longer story is in the newsletter posted nearby. Mortgage rates have fallen again, long-term rates have fallen again, and the story is well nigh incomprehensible, but it starts 3 months ago. Long-term rates crested in November, 4 months ago. The Fed met on the 19th of December, and in the worst single error in my working life, like almost 40 years anyway, the Fed created the impression that it was going to continue to raise interest rates until doomsday, and the stock market collapsed. The financial markets in general nearly locked up. It was followed, of course, by the shutdown, but the Fed spent the next month after December 19th in an unseemly, undignified haste to say we didn't mean that, you misunderstood. And Chair Powell learned a lot about public communications. The Fed itself learned a lot, and by January the assumption settled into markets that the Fed was going to pause. The Fed was going to be patient. And as time passed, it was becoming more patient, and the pause became open-ended. And we could tell by the financial markets' reactions to what the Fed had to say. And so this Wednesday, Fed meeting, I thought, old-time bond people figured that the market had begun to price in Fed easing, that the next move was going to be a cut, not a hike. And I assumed that the Fed wouldn't like that the Fed would think that the market had gotten ahead of itself. We're pausing, we're not cutting here. And so noon on Wednesday, here comes the Fed with all of its usual smoke signals and flapping of blankets over fires, and the Fed made it very clear that it's already eased. It hasn't cut its overnight cost of money, but it's doing everything that it can to make money easier. In particular, the Fed, through quantitative easing, bought a great many bonds and mortgages and had begun to taper those holdings off. Marketplace assumed that by the end of this year the Fed would announce a plan for how far down those holdings were going to go, meaning how much of it was going to be moved back into the market. On Wednesday, the Fed announced the end of it, and the end will be in September. So it brought forward the conclusion of the shrinkage of the balance sheet by a little more than a year. The Fed also released its DOTS forecast of future intentions. And there are a handful of boobs who still want the Fed to raise rates, but the very large consensus at the Fed is we're done. We're done for this year. And the Fed, to try to understand what this means and what to do with interest rates now, it's crucial to keep the past, the present, and the future clear. It's not so much that rates are going to go down, they already have. It's not that the Fed is going to ease, it already has. The Fed has eased so much that it has counteracted at least the last two tightening moves last year. The 10-year Treasury note is the benchmark for long-term money, and its yield has now collapsed to where it was at the end of 2017. And it's down almost a percentage point since November. So the vote here is take the bird in hand. Do not expect further drops unless the world comes to an end. The yield curve did finally invert. Pay no attention to that. The immediate trouble and the further decline in rates today, Friday, is because of news out of Europe that the world is coming to an end in Europe. Brexit's running out of control. The European economies all sagged into really recession-style reports, and China's in significant difficulty. This is all external to the U.S. It's not in the U.S. At the moment, all we have done is slowed down, but the Fed has already eased and eased a ton. So mortgage rates are down somewhere around 4.25, 4.375, depending on the structure of your deal. Don't wait for lower, take it. Have a good weekend.